Welcome back to Analyst Bites. Today we are focusing on a core CFA topic that trips up a lot of candidates: free cash flow. The reality is, if your level 1 foundation is shaky, the complex FCF model in level 2 will just leave you frustrated. To fix this, I've structured a 3-part series to bridge that gap. We will walk through the common misunderstandings step by step. This is part 1, the foundation. We're going to break down the cash flow statement from indirect to direct method and clarify exactly how to identify cash flow directions and US GAAP vs IFRS based on logic, not memorization. No fluff. Let's get straight into it. Before we dive into the theory, let's look at a real-world cash flow statement. On the screen is the cash flow statement from Starbucks 2025 10K. It's quite long, so I split it into 2 parts. Right now, you are looking at the operating cash flow. Starbucks uses the standard convention. Positive numbers means cash inflow, and parentheses means cash outflow. This is a classic example of the indirect method. We will cover almost all these line items in our upcoming calculations, so just take a mental picture for now. Here is a quick tip. Accounting standards actually encourage companies to use the direct method. However, if a company chooses the direct method, they are strictly required to also provide an indirect reconciliation. To save time, 99% of companies, including Starbucks, simply report CFO using the indirect method. One more detail you might have noticed: the reporting date isn't December 31st. It's the end of September. Under US GAAP, companies have the flexibility to choose their own fiscal year, so Starbucks' fiscal year simply runs from October to the end of September. Now let's look at the bottom half of the statement: investing cash flow and financing cash flows. Here is a key rule you need to know. Unlike CFO, both US GAAP and IFRS strictly require companies to report CFI and CFF using the direct method. There is no alternative. Starbucks keeps its textbook standard here. Look at the first line. Purchases of investments are in parentheses, meaning cash went out. Further down, proceeds from insurance of short-term debt are positive, meaning cash came in. Finally, if you add up the net totals from CFO, CFI, and CFF, you get the net change in cash for the year. Add the beginning cash balance to that, and you arrive at the ending cash balance at the very bottom. A quick tip here: this exact ending balance must tie perfectly to the cash line item on the balance sheet. You will see this linkage a lot in financial modeling, but for now, just keep this big picture in mind. Warm-up is over. Let's get to the core of today's lesson. How do we adjust net income to find the true CFO using the indirect method? You need to make 4 major adjustments. Number 1, non-cash charges. We will dive deeper into NCC in the next video, but the classic examples are depreciation and amortization. Think about the income statement. Depreciation is a huge expense that reduces your net income. But did the company actually write a check for it this year? No. Just like this Lockheed piggy bank on the screen, no cash actually left the building. So to find the true cash flow, we must add it back to net income. Number 2, non-operating items. The classic example is the gain or loss from selling equipment. Ask yourself, is buying or selling machines an operating activity? No, it's investing. Look at our importer money bag. It wears an income statement jacket and changes your net income, but its true identity belongs to CFI. Since it's not an operating activity, you must reverse it. If a gain increased your net income, you must subtract it. If it's a loss, you add it back. By the way, we will dive deeper into fixed capital investment in part 3 of this series. For number 3 and 4, we need to understand the accrual illusion. Net income does not equal cash received. Because of accrual accounting, revenues and expenses are recorded regardless of when cash actually changes hands. This timing difference creates a gap between net income and the CFO. Let's look at number 3, working capital assets, like inventory. If you buy inventory and sell it immediately, it goes into COGS and reduces net income. But what if you buy more goods than you sell? Your inventory increases. What does this mean? This extra inventory did not hit COGS, so net income didn't drop, but you already paid cash for it. Therefore, when inventory increases, cash flows out. You must deduct it. Conversely, if inventory decreases, you are selling old stock without spending new cash, so we add it back. The golden rule for working capital assets: increase means subtract, decrease means add it back. Finally, number 4, working capital liabilities, like accounts payable. Accounts payable is money you owe suppliers. If your accounts payable increases, it means you received goods but held on to the cash you were supposed to pay. You essentially got a free loan from your supplier. It acts like an inflow. Conversely, if accounts payable decreases, you paid off past debts, which is a cash outflow. The golden rule for working capital liabilities: increase means add it back, decrease means subtract. That was a lot of theory. To make it stick, let's jump straight into the battlefield and see how the CFA exam tries to trap you. Look at question 1. A company reports net income of $200. This includes a $30 gain from selling old equipment. Depreciation is $10. What is the CFO? How do we crush this? Remember our visual anchors from the last slide? First, look at the depreciation. That $10 is our locked piggy bank. It's a non-cash charge. Since no cash actually left the building, we must add it back. Second, look at the gain from selling equipment. That $30 gain is our importer money back. Selling machines is an investing activity. It has zero business being in CFO, so we must kick it out and deduct it. The math is simple. 200 minus 30 plus 10 equals 180. So the answer is A. Once you spot the non-cash ghosts and the imposters, these questions are free points. Now let's look at question 2. A company's inventory increased by $40. Do we add or deduct it for CFO? Picture that full warehouse and empty wallet. An inventory increase means you bought more goods than you sold. It didn't reduce your net income, but the cash physically left your pocket. Cash out means deduct it from net income. So the answer is B. Done. Question 3. Accounts payable increased by $25. How does this affect CFO? Think back to that IOU note. Accounts payable is basically an interest-free loan from your suppliers. An increase means you held on to the cash instead of paying them. Keeping the cash in your pocket acts as a cash inflow. So the answer is A. Increase CFO by $25. Time for the final boss. Look at the data dump. COGS 100, rent 20, depreciation 15, inventory 10, accounts payable up $5. How much cash was paid to suppliers? This is a classic direct method trap, less tested than the indirect method, but you must know it. Step 1 to crushing this: ignore the noise. The question asks about suppliers. Suppliers only deal with inventory. Rent expense goes to your landlord, so kick it out. Depreciation is a non-cash cost, so eliminate it. Now do the math. Your baseline expense is COGS, $100. Inventory increased by 10. You bought extra goods, which means $10 extra left in your pocket. Accounts payable increased by 5, so your supplier gave you a free loan. You saved $5 in cash. 100 plus 10 minus 5 equals 105. The answer is A. Alright, we've successfully conquered the core mechanics of CFO calculations. Now let's move to our next battle, decoding those sneaky plus and minus signs on the cash flow statements. Now let's look at the logic behind these signs and see exactly which versions the examiners have in store for you. Look at the left, the standard statement. Just like Starbucks, positive means inflow, parentheses means outflow. Very intuitive. But on exam day, CFA loves to throw this trap statement on the right at you. Let's look at the first line in CFO. Increase in accounts payable is a positive 50. Wait, we just learned that an asset increase is a cash outflow, right? So here, the number simply states the accounting change. Do not fall for the positive sign. You must manually deduct this 50. Let's look at these two items. The increase in inventory, negative 30, and increase in accounts payable, positive 40. They switch back to actual cash flow signs. So always read the text label with the sign of the numbers to determine if the cash flow is an inflow or an outflow. Look at the CFI section. Notice the header, cash used in investing activities. Since the header already sets the tone as an outflow, purchases is listed as a positive 50, and proceeds from sales, actual cash coming in, is negative 10. The net result is a positive 40, but its true meaning is a net outflow of 40. Next, if you look at the CFF section and get confused, use this trick. Find an anchor. Find a no-brainer item, like dividends paid. We all know paying dividends is 100% cash going out. But look, it's listed as a positive 10. You just decoded their metrics. In this table, positive means outflow. That means repayment of borrowing of 20 is also an outflow. The total 30, pure outflow. Every trap on this slide is pulled directly from the official curriculum practice problems. Master this slide and you will have X-ray version on exam day. Let's look at the next slide. This is a frequently tested topic in both Level 1 and Level 2. How income statement items are classified on cash flow statement. It involves comparing the two accounting standards. First, US GAAP. Just to remember one rule, US GAAP requires strict comparability between CFO and net income. Therefore, any item used to calculate net income is classified as CFO. Look at the summary. Interest income, interest expense, dividend income, and taxes are all recorded on the income statement. So under US GAAP, they must all be included in CFO. Notice dividends paid. Dividends are distributed after net income is calculated. They are not part of net income, so they are naturally classified as CFF. Now let's compare this with IFRS on the right. IFRS is more flexible. It classifies cash flows based on their economic substance rather than aligning them with net income. Because it focuses on substance, investing-related items like interest received, dividend received can be classified as CFO or CFI. Financing-related items like interest paid, dividends paid can be classified as CFO or CFF. Taxes are the most unique, since you can pay taxes for operating, investing, and financing activities. The cash outflows can be allocated across CFO, CFI, and CFF. Now that we've covered the concepts, let's see how this is tested in practice. Question 1. Under IFRS, a company received $50,000 in dividends from its equity investments. How can this cash flow be reported on the statement of cash flows? This question tests the core IFRS principle, economic substance. What is the true nature of this dividend? It is an investment return. Since it is a return on investment, it can logically be classified as CFI. Of course, IFRS also allows you to keep it in CFO. Therefore, the answer is C. Very straightforward. Question 2. An analyst is comparing two companies. Company A, under US GAAP, reports interest paid as CFO. Company B, under IFRS, chooses to report interest paid as CFF. If the analyst reclassifies Company B's interest payment to CFO to match Company A, what will be the effect on Company B's adjusted cash flow measures? Now here is a common trap. Don't think that because we are moving the interest into CFO, the CFO activity is increasing and therefore the number gets bigger. That's not how it works. We need to focus on the net balance. Think of interest as an outflow. It's money leaving the pocket. When we remove this outflow from CFF, there is less money being deducted, so the net CFF increases. But when we add this outflow to CFO, it's an extra deduction, so the net CFO decreases. And that's why the answer is A. Key takeaway here, always look at the final net amount, not just the volume of transactions in that category. Let's move on to the next one. A multinational firm follows IFRS. They paid $1 million in taxes, and $20,000 is directly attributable to the sale of a manufacturing plant. How should they report this? Under IFRS, taxes are flexible. Usually they sit in CFO, but they can change color based on the transaction. Since that 20,000 comes from selling equipment, which is an investing activity, it can be reported under CFI. The remaining 80,000 stays in CFO. That leads us to choice B. Now you might wonder, why is choice A wrong? Can't they just put everything in CFO? Technically, they could, but look closely at choice A. It uses the word must. In the world of CFA, must or always are major red flags, because IFRS gives companies the choice. Saying they must put everything in CFO is simply incorrect. When you see such extreme language, it's usually a trap. Now let's look at an advanced problem. You will often see this type of question in the end of chapter exercises. The question asks us to calculate a ratio based on CFO that is comparable to EBIT to interest ratio. We have the value for CFO, tax paid, and interest paid. The key here is to match the scale of the numerator and denominator. EBIT stands for earnings before interest and taxes. So we need our numerator to be cash flow before interest and taxes. Under US GAAP, it's easy. Both interest and taxes are subtracted from CFO. So we just add them both back to get the pre-tax, pre-interest number. But here is a twist in this specific question. The problem states that while taxes were paid under CFO, interest was reported under CFF. Think about what that means. Since interest was paid out of CFF, it was never taken out of the CFO in the first place. So when we add CFO to a pre-interest basis, we don't need to add it back. It's already not there. So the calculation is simple. The numerator take CFO and add back only the taxes paid. The denominator use the interest paid. The formula is CFO plus tax paid divided by interest paid. That leads us to choice B. The takeaway: only add back what was actually deducted. If it wasn't deducted from the start, leave it alone. Finally, let's look at this question. It's adapted from a unique practice problem in the curriculum. The question asks, which classification of cash flow is considered the most conservative? Typically, conservative in accounting means choosing the method that results in the lowest reported figure. However, if we follow that rule here, both A and C would decrease CFO. Since this is a multiple choice question, there can't be two correct answers. The real focus of this question is the principle we discussed earlier. Under US GAAP, the goal is to align cash flow classification with net income. In this context, most conservative means the classification that most accurately matches the reporting of net income. So let's look at the logic. Choice A, classifying interest received as CFI is incorrect under US GAAP. Choice C, classifying dividends paid as CFO is incorrect because it's a financing activity. Choice B, classifying dividends received as CFO aligns perfectly with how it's recorded in net income. Therefore, the correct answer is B. This question differs from the standard definition of conservative. I'm highlighting it to show that exam questions aren't always perfectly phrased. You need the ability to reverse engineer the examiner's intent from the available options to stay ahead on exam day. Alright, that is the foundation of cash flow. You now know the rules, the science, and the logic. But don't get too comfortable. CFA Level 2 will not just give you depreciation and let you calculate FCF. In the next episode, we are diving into the deep end. What happens when the exam throw deferred taxes and impairment at you? Can you still find your non-cash charges? And what about working capital investment? Do you know why short-term debt is a deadly trap in your formula? And why the FCF formula says minus working capital investment, but sometimes you have to add it? We are going to decode the CFO engine. I'm Analyst Bites. Every problem here is to help you ace the exam. Every insight is to help you see through the business world. Let's take the CFA out of the textbook and into your real life. Thanks for watching. I will see you in the next one. Bye.